So welcome everybody. Welcome to the Innovacorp Investment Readiness Series presented by Startup Yard at COVE. My name is Shelley Hession. I'm the manager of Startup Yard, which is an Innovacorp incubator focused on ocean technology startups. So the session today is part one of a four-part series, and the title of today's session is Introduction to Venture Capital. So before we kind of get into the session, we'll do some housekeeping. But before we do that, I'm going to invite Jennifer Paciullo to talk about the other workshops in the series.
Thanks, Shelley. So first, just want to say fantastic seeing everyone here today. Very exciting to have so many exciting ocean tech startups in attendance. As Shelley said, this is part one of a four-part series in our investment readiness series. So the following three sessions will be held over the next 3 weeks, same day, same time. So Wednesdays at 1 p.m. Atlantic Standard Time. The next session will be on December 1st, and it's called Developing Your Funding Path. The third session will be on December 8th and is The Art of the Pitch. And our fourth and final session will be on December 15th and is on Closing the Deal. Many of you have already signed up for these sessions, but if anyone has yet to sign up and is interested, please shoot me a quick email to RSVP, and you can find my email in the reminder email for today's session. That's it for me. Again, welcome. I'll pass back to you, Shelley.
Thanks, Jennifer, and a big thanks to Jennifer for being the organizer and the brains behind this series, so thanks. A few housekeeping, so please be on mute when you're not speaking. Due to the large numbers, we'll save the questions till the end, but if you've got questions, please put them in the chat as we go through. We're recording the session. Slides will be available after. So that's our housekeeping. Now, let me introduce Michael Dennis, our speaker for today. So Michael Dennis is an investment director at Innovacorp. His focus is clean technology, but he actively works with ocean tech companies and manages a few of them through the investment portfolio. So Michael manages all aspects of the investment review, approval, and closing cycle. He has got startup experience himself. So prior to joining the Innovacorp, Michael was the CEO of Performance Genomics, where he led a turnaround based on strategic partnering and financing for the company's R&D. He previously founded Blue Bio Sustainable Biotechnology, a biotechnology consulting company based in Nova Scotia. Michael spent 15 years in Montreal, and when he was there, he was co-founder and CEO of BioSignal, a biotechnology tools company that raised several rounds of venture capital. He grew it to profitability, and it was acquired by a US multinational. So Michael holds a BSc and a master's in BSc from Dalhousie University, and has got a doctoral in biochemistry from the University de Montreal. So welcome, Michael. The floor is yours, and we're very excited to hear about venture capital.
Thanks, Shelley. Welcome, folks. Pleasure to be here. Dennis, as Shelley said, I have some experience in startup too. Actually, in '91, I was just about where you are now, looking for my first venture capital investment in a company that was not yet operational, or barely. So I've been on the path. I joined Innovacorp in 2014, so bringing experience as an operator and founder to this role as an investor, changing side on the table. I've learned a lot in the 7 years. Great experience. I'm happy to share some of that with you now. My presentation is primarily focused on what the heck is venture capital anyway. There will be some references to what you should be thinking about taking to venture capital, but this is primarily a look inside the box. But I'll finish my presentation, my seminar with some advice on what you can expect venture capitalists to want to see from you and what you should expect to see from venture capitalists that you bring into your company, because it's a two-way street. So to start it off, financing for startups, that's the play. How do you put fuel in the tank to meet milestones and grow your company? This just gives, this is from 2015, but it's pretty much unchanged. Where do startups find first financing? And you can see the vast majority of that is from the bank and loans and personal savings. That's how most companies start. Most of them fail, but most of them start that way. The very limited participation of venture capital under 5% is for a select group of companies, a select group of startups that meet certain criteria. I put angel investors in there as well. It's essentially angels, people with lots of money, high net worth individuals that will invest in startups and try and help them, fall into the same kind of bucket, different structure, but a similar lens. Everybody wants to make a high return for a high risk investment. But as you see, venture capital is a small piece of the landscape, and it's not for everybody. And it's, you know, on you to determine whether venture capital is the route for you. And we can talk about what that route would look like. So on, you know, capital structure is standard for a company. Your assets, obviously, what's on the books, but then financing for operations is obtained. Grants, of course, but primarily either through debt or equity. And it's really based on how big is the risk. The debt comes in with low risk proposition. They're ready to take a low return, but they're almost assured to get it back. And they'll take their upside on interest and the return of capital. And what's nice is they don't take ownership. They may take security over assets in your company or even your company, but they don't take ownership. They won't tell you how to manage it. High risk operations, high risk companies need to go find a different kind of money where they share ownership. They need to be able to show that they're going to deliver a high return in return for coming in on a high risk venture. Return based on dividends, standard, but essentially capital growth, and we'll talk about it. For venture capital, capital growth is everything because that's how they make their return. They exit based on increased value. But when you make a deal with those equity investors, you give up a share of ownership and you give up rights. You give up voting rights on what it is the company is going to do. But then you also have co-owners in the company who are as committed to the success of the company as you are. So again, just making that distinction between debt and equity as financing. Venture capital, like what is it? It's a financing tool, but specifically targeting high risk, high reward opportunities, companies. So it's a financing tool for those companies, but it's also an investment vehicle for institutions and wealthy individuals for them to earn high returns on their money. They can put their money into the classic stock market, which is going to earn them their 6% over whatever. But when they're looking at putting money into a venture capital operation, a fund, they're looking to double, triple their money. So that's why they go in. They're looking for higher returns. And the business model of venture capital is venture capitalists. The people that create that opportunity, that financing vehicle that investors put their money in and that companies seek investment. And that's how venture capitalists make a living. So let's talk a bit more about that. First, what's profile for a VC investee? And again, this is the equity side. Pretty standard. There's a high level of uncertainty. Nobody knows at this stage Will this deliver? In most cases, the companies are pre-commercial. Their intellectual property hasn't been secured. Their route to market hasn't been defined. So there's a high level of uncertainty. The company has intangible assets, generally a bit of equipment, but it's more trade secrets and intellectual property, patents, etc. They are revenue negative. I like that one. Not pre-revenue, it's revenue negative. They're burning money. They are high risk, but they have high growth potential. And that is what defines the venture capital lens. High growth potential and high potential for excellent returns on investment. So this is what an investee for VC needs to look like up front, what they generally look like. This illustrates the path where venture capital fits. So you've probably seen this, the J curve, this J curve on startup path, beginning with the concept idea, and then spending money to be able to take that idea through product development and the business rollout to be able to start selling. And that initial phase at the revenue negative, losing money, requires investment. And that very earliest at startup stage is seed investors, seed venture capital, and angels, where they generally play. And as the company progresses, different stages to securing customers and requiring funds to grow the company, then investment goes to a different type of vehicle, different type of venture capitalist, early stage VC, who's not funding startup. He's funding something that looks like it's operating and has high potential and comes in at that stage to help the company grow. And then there's later stage VCs that look at a company that now is having success and sees a potential for an exit in a relatively near term, comes in at a later stage to essentially, as I read, add kerosene to the fire. Everything is working extremely well. And everybody's moving to that final stage where there's an exit, that someone is acquiring the company's shares, and that all of the previous investors exit the company with a return on investment. That's generally, you've seen this valley of death, where the company is negative, cash negative, cash in the bank, but cash flow negative is the highest risk period for the business and where the companies generally fail, but it's where the venture capitalist has the most value in the angels, because that's where the company needs them the most. This similarly, just to show, as you go from the idea with that FFF, family, friends, fools, who's going to come into the first investment in a company that's still just an idea, and angels, but then through seed and venture. But just to show that the blue line shows that as it advances, the risk goes down. So the appetite of investors goes up, but different kinds of deals, different kinds of expectations. At this point, I anticipate that everyone that I'm talking to today is in those first two boxes. The idea to first customer stage. So you can see there are different places where VCs can play. Venture capital essentially been around for a long time, but formally it really got started after Second World War in the 40s with Silicon Valley and the chip business being the first real drive for venture capital returns. But this just shows how active venture capital is now. You can see those are quarterlies, and in US, in the last, since 2017, there's 40 to 50 billion dollars per quarter going into startups and early stage companies from venture capital. So an enormous amount of money 750 billion since 2009. So, essentially a decade's worth, a lot of money going into venture capital. There was a little drop on COVID in 20, but that has rebounded with a vengeance. And the stage where that money goes, you can see on this one, the angel seed, the blue, is always a very small proportion of the total funding that goes in from venture capital into VC companies. But it's the most numerous deals, a lot of deals, a bit of money to see who can get to the next stage, essentially. But you can see that most of the money is going into late stage. That's where the 50 million to 100 million investment can take a company from 10 million sales to 100 million sales. That's essentially where the later stage VCs play. But continued growth and the angel seed stage, your stage of investment, continuously a small proportion, but the largest number of deals. And where do they invest? Well, they invest in sectors where there's lots of upside. This is a relatively old one, 2018, maybe. But as you can see, most of the investment in the last 20 years has gone into software, because software is the lowest capital intensity, the highest margins, the highest upside, and it actually is a sector where you can learn pretty quickly whether your company is going to make it or not without investing a lot of money. So software has been the play, and that includes all of our internet companies, Facebook, Google, et cetera, et cetera. But you can see it's spread across different disciplines, but the two largest, software and biotech on this one, in this time period. But that's a moving target. What was a venture capital play 10 years ago may not be now. It may be a stage, or at least 20 years ago. Clean technology plays a very small part in this this depiction, but there's a very strong rise in interest and capital being dedicated towards climate tech opportunities, specifically the decarbonization of industry, which would be reflected on here. Next year, there'll be a different picture, but essentially it goes where the highest returns possible are located. And the success factors for companies, venture capital companies, sort of drawn from experience from a lot of companies, sort of lines up like this as the top 5. Timing being the most important factor. Are you at the right time to deliver an innovation to a market that wants it? Next, team and execution. Good idea, bad team will make it. Bad idea, great team might. Great idea, great team is what venture capitalists are looking for. But team and execution is like the critical factor in being able to deliver. Idea, business model, funding all line up as well. But again, timing of the venture and the team proposing to deliver it are the top factors in a venture capital lens. This one from Steve Blank kind of sums up what a venture capital venture capital investor is looking for in startups. To be scalable, to be able to grow, designed from intent to become a large company. The founders believe they have a big idea, one that can grow to 100 million or more in annual revenue by either disrupting an existing market or taking market customers away from existing companies and creating a new market. Scalable startups aim to provide an obscene return to their founders and investors using all available outside resources. So it's about the team, it's fierce founders, and it's about being able to demonstrate a potential and a mission and a passion to be able to deliver these types of returns. So I'll shift a bit to what is a VC fund? What's a venture capital fund? Essentially, it's the venture capital firm, the general partners, go out to the market to raise money themselves. Just like the companies go out to market to raise money, venture capital firms go out to pension funds, corporate funds, high net worth individuals, family offices, governments, funds of funds, others identified as limited partners. They're the ones that the venture capital firm convinces that they have an opportunity to give exceptional returns for money invested based on investing in startups. And that's what they do. The venture firm brings together the LPs money into a fund, a pooled limited partnership, and then goes out to the market to find companies that will invest that money into. The process that a venture capital firm has in front of it is once fundraising, the investments need to be selected, diligence made, the companies evaluated, investment deals prepared and closed, investment made. Then the work starts of helping companies through a period where they will grow. And venture capitalists generally are actively helping companies deliver on their milestones. They're obviously helping up front to identify and validate milestones that will be important to increase capital value, the value of the company. But the operation is destined to deliver increased value for the company and then to exit either through merger acquisition, selling the company to another company, or through initial public offering or variants of the IPO to end up on public markets, to take the money out and to distribute it to the individual institutional investors that came into the LPs. And to share in that upside, the venture capital firm has a piece of the action. Generally, 20% of the returns go to the venture capital firm and the remainder goes to the limited partners. This J curve, another one, kind of shows the life cycle of a fund. This is a 10-year fund. That's pretty standard, meaning that the company, the VC has to deliver everything in 10 years and return capital to the LPs at the end. Generally, it's 5 years of investing. So the whole fund will be deployed in first investments and follow-on investments over 5 years. And then in the remaining 5 years, it's exit. So delivering returns. So this shows like money's going out the door in the first 5 years and coming back in on exits in the next 5 years. That's the scenario everybody wants to see. And venture capitalists, you look at it, as an industry is pretty successful. This shows venture capital backed exits in US, I believe, by amount and type over the last over 12 years or so. But as you see, total exits in 2018 were $120 billion. Essentially split half and half between mergers and acquisitions, selling the company to other companies or through IPOs or similar to list on public markets. Small percentage are bought out by private equity firms that buy out the initial investors and carry them forward, again, generally to get to IPO or merger and acquisition stage. But the VCs exit when the shares are bought. So pretty successful. About 90% of the investments of venture capitalists don't deliver this exit. 2/3 fail. Most are relatively zombies or they're operating but don't deliver. In fact, this shows over a period 89 to 2011. And again, it's the same now. The idea that most funds underperform. So this shows one here would be the money came back, and the bars represent funds. So the mean for all these 200 funds, is that what I saw there? For these funds, the mean return was 1.3, so a 30% return, not a 3 times return, which venture capitalists and LPs expect to see as a minimum. And you can see that a very few companies deliver top tier 8 times capital, or as you see, 3 times capital. These are the ones that make a venture capital fund successful and deliver returns to limited partners. Most funds do not. So it's not a normal distribution, it's the power law. Very few deliver all of their returns. So the whole question is, how do you get those very few? I just threw this in, shows 25 of the best venture-backed exits, and you can see companies there, you know. Google didn't deliver that much on the initial IPO, what they've essentially soared in value. But as you can see, Google, Facebook, Alibaba, Zoom right here. These are the companies that over time, over this period, delivered outsized returns on exits. So the best of all time, as they say. Realistically, though, this is what venture capital performance ends up looking like. 5 losers for 10 investments. 5 losers, they go bankrupt. 3 small, 1 medium, and 1 large exit delivers all of the returns of the fund. So companies, venture funds that are unable to secure this 1 major exit fail in delivering outsized returns to their limited partners. So again, it's that 1 exit in 10 that's critical. This summarizes internal rates of return over time, but essentially the message is longer it takes, the lower the rate of return for the LP. Earlier you get out with the high return, better off everybody is. So the secret sauce of high potential return in a time frame that makes sense for the company, makes sense for the return. But as a bottom line, on the venture capital lens, 1 in 10 funded companies will be successful. So each investment must have a 10-time return potential in order to meet expectations. In other words, if a startup doesn't have potential to alter the state of an industry in a market worth billions and generate more than 100 million in revenue annually, it won't make sense for a venture capitalist to bet on. So as a lens, stepping back, looking at your company and how you're positioning to approach investors, this simple equation becomes the venture math that you need to be able to grapple with. You need to be able to generate 100 million in revenue in a market that where you are able to solve huge problems. So what are VCs looking for? And we could talk a long time about this, but essentially, the top line again is they're looking for return, high return, and to be able to deliver that, they need to assemble elements to have the potential for return and to minimize the risk of reaching that. So massive markets are top of line. And in our process, venture capital, we need to understand that a customer for a startup, and that's one customer, not 12 different types of customers, but one type of customer for a startup has a pain, a problem that's costing them $10 billion a year. Or that they're losing out on $10 billion of new revenue potential a year because they don't have a solution. And that the startup, the company can deliver that solution to access that 10 billion at a cost of $1 billion. Essentially, you're going to charge 10% of the upside for your customer to be able to deliver that upside. Obviously, that's top scenario. That gets sort of degraded as you start to dig into the company can be degraded to maybe it's 5 billion paying and maybe it's 2 billion. So then, okay, why are we looking at this company instead of a company that has the 10 and 1? Why are we looking at the 5 and 2? Maybe it's because there's other areas. There has to be an argument. There has to be a good argument to say that the customer pain is so acute, or their concern about missing revenue opportunities so acute that they are actively looking for the solution that you are offering, and that there is excellent traction for adoption. Not traction, but they're going to adopt it because they need it. This is a critical top line. Who's your customer? What's their pain? What's their solution? What are the numbers that line up? Does the venture math work? The second element, which the product market fit and customer traction, that is something that occurs as a company advances. Like first startup at seed stage generally doesn't have the product market fit determined. That's something that's determined in interacting with the customer. And customer traction, meaning, do you have pilots? Do you have sales to customers? Again, that's something that generally is post your stage. I could be wrong. Some of you may be in position now where you do have some product market fit. You've completed pilot studies with your prototype, with a real customer. They've signed on to their first. But in general, you probably don't. But definitely, that is an objective, and it's a critical step in path of the company to future investments. And as we saw, it isn't one venture capital investment. It's the first and the second and the third until exit. Barriers to competition. This is important. Doesn't make much sense to create the opportunity by putting the company in market and having a more efficient or better capitalized company come and eat your lunch. So it's about how do you build barriers? And barriers are different kinds, patents, trade secrets. What is it that how do you protect the technology from other companies coming in to practice it? Obviously, that's as good as your ability to defend it, which costs money. But patents generally are an important part of an acquisition strategy. If you are going later in life to potential acquirers, companies that would acquire you and integrate you into their operations, then patents become very important and they are in a position to protect them. So important as a piece of a portfolio later. Partners, obviously, if you have channel partners that own a piece of market that you're accessing, and you can make the case that you have a barrier because those customers will be yours because they're your partner's customers, or complementary technology where you can work together with a partner to build a full solution that incorporates your solution. These kinds of things, that can be a barrier as well. In the software space, generally, it's the traction that's the most important barrier. You're growing quickly and you're acquiring customers. That's seen as you're building a barrier to the next guy coming through. And network effect that if you were able to get first customers, the next customers come in very easily at low cost. Probably, again, after timing, this next one is likely the most important. Like the first one, massive market, is a given. It has to be there, but impassioned, balanced, coachable team, technology plus business. This is where rubber hits the road. This is how companies succeed. They have a massive market with a great solution. They're able to build barriers to competition, but they need to have a team that is on a mission, that is filling the gaps, and that is coachable, meaning as you take on investment and investors, they're going to want to know that you are going to listen to them. They generally have done it before. They've seen it numerous times. They have networks. They have founders in their current companies. All of these can be assets for your company to help you progress and navigate, but you have to be coachable. So it's about, for a venture capitalist, you are taking on a partner and they want to feel that they're a partner and that you're working together. And that's going to be part of what's being determined when a venture capitalist looks at you for investment. And if there are gaps, recognize there are gaps. Always transparent, because it never works to try and hide holes. They will be revealed. So the idea that if there are gaps, you recognize them and you intend to fill them. And part of what you're going to do is use the money you raise to fill those gaps to build a better company. There needs to be a credible go-to-market strategy and a business model that's scalable. And credible go-to-market, a tech company selling to other companies doesn't do web-based sales. It's just not going to work. It's not enough to say we're going to sell our solution over the web to anybody who wants it. Like, that's the worst possible thing to say. The thing to do is think about how your customers buy solutions now and how can you access those customers with your solution. Very often that is a few companies or even one early adopter up front to help you validate your technology that you can then take to other customers one-on-one, or it's a channel, a company in market selling solutions that you can get on board with to sell your solutions to those same customers. A mix of both. And the scalable business model, like as you grow, the cost of your solution needs to drop and your margin needs to increase. Essentially, that's the scalable piece, is that it's evident as you grow your business that scaling production and sale is going to decrease cost of sales, cost of goods sold and cost of sales, so that margins increase. As the company grows, margins increase. The other piece is to be able to grow, you have to demonstrate that your customers will be ready to buy, that there's enough market there to adopt your solution to the extent that you're proposing, and that the things needed for you to deliver your solution, like feedstocks, if you're producing a chemical, parts, if you're producing a device, that you're able to continue to secure those as volumes needed increase logarithmically, because that's the idea. Scaling company needs to be able to access everything it needs to deliver its product, and it needs to increase its margin as it goes. Timing, there's our timing again. And Lance, the two critical pieces, is the customer pain evident and growing? No, on the clean tech side, the pressure to reduce carbon is a pain now, and it's a growing pain, and it will get worse. So, like, solutions to reduce carbon in the market have a good customer profile at this point. Of course, everything depends on the specific solution and the customer, but as well, they have to be ready to adopt them. Big companies are generally slow to adopt, so there needs to be a strategy to and some kind of evidence that the companies you're targeting and customer will be able and willing to adopt your solution in a timely manner, consistent with the funding rounds. Pretty bad to say that you're going to have customers ready to adopt in 3 years, and in 3 years you still have no customers, and you're just about out of money, and you need to raise more money when you should have been raising the next stage. You are now looking to bridge to be able to get to the customer before you can raise the next stage. Finally, all the venture capital firms are not created equal. They focus on different stages. Innovacorp, for example, is a pre-seed to Series A company, a venture capital investor, pre-seed to Series A. Cycle Capital, a clean tech investment venture capitalist in Montreal, is Series B to Series E. So the thesis, the focus of the VC firm is clearly stated as part of their vision and their lens. So always look for the VCs that are appropriate for the stage. They also focus on sectors. Some are only in finance, IT. Some are only in low carbon solutions. Some are only in ag tech, regenerative agriculture solutions. Some will only be in maritime logistics. So you can see that your business will land in the focus area for a venture capital firm, and you should be very direct in picking venture capitalists to approach that align with the sector, with your sector. Thesis. Again, there are clean tech investors that their thesis is funding the rollout at scale of current technologies, EVs, energy storage, renewables. And there would be a later stage investor as well. Whereas another company, another venture capitalist may be totally about, we're looking for low carbon opportunities at pre-seed stage that haven't been validated as technology at this point, and doubling down on helping companies get across that first validation stage. And finally, by region, venture capitalists generally like to invest in companies that are close by so that they can visit with them regularly. That's in this world, remote world, that's not as probably as fixed as it was, but still there are VCs generally a regional focus. So you can look to VCs that match your location. So yeah, so the market opportunity, the product market fit, the barriers, the team, the strategy to go to market, the nature of the model, business model, timing, and the fit with the VC firm's focus. Line them all up on your side before you go talk to VCs and identify like what it is you're going to be able to offer. I pulled this out of this morning looking at stuff. The venture capitalist investing early in 3 companies, 1, 2, 3. Startup LK and where are we? W. And you know, at that early stage, pretty hard to tell them apart. So a venture capitalist at that stage is going to take bets based on those criteria we talked about, but they're going to take bets and they know they're not going to work, all of them, but they're going to take bets and then they're going to double down on the bets that look like they'll work and they'll drop the others. Because venture capitalists make a first investment with the intention of following on a second round and potentially a third, but in order to attract other investors, but essentially to double down on the ones that looks like they have opportunity to succeed. You can see right here this, the elbow when a company starts to have good shit happening is on the axis there. That the right time for an early, I guess, a seed stage venture capitalist to double down is when it's clear that there's going to be an upswing in value because the company is meeting milestones. And we talked about those criteria of progress, but for the venture capitalist, it's okay, 3 that are relatively similar. Who's going to be in at a position to show progress in the time frame for the next investment based on the resources that they've secured? Who's going to show significant progress and be the one that gets the follow-on investment? And that's a decision for venture capitalists. They're not going to follow on everybody. They're not going to keep companies alive because they've got capital invested. They're not going to put good capital against bad capital, bad investment. Obviously, sometimes circumstances determine that a VC will add money in a bridge round to be able to extend the runway for a startup to be able to meet key milestones, to drive that next investment. They don't like doing bridge rounds, but they will. But essentially, the message is there. Not all companies will make it. Venture capitalists need to define what are the key indicators, the key metrics of success, and then double down on the ones that start meeting those metrics. So this is two-way street. You are looking, if you're looking at venture capitalists, you're looking for a partner who's going to be there for a long time. And you're going to have to put up with that venture capital partner. So choose them. And what is it that you should be looking for? I'm sure you have a really good idea already, but you want venture capitalists that can add value to your company beyond money. Money is the essential piece, but it's probably the lowest value that a venture capitalist should be able to bring to help your company. One of them is their network. And that essentially depends on their focus, their sector focus. Is it relevant to your venture and to your customer? The network of that venture capitalist. For example, a green energy venture capitalist will likely be connected to utilities, to the Siemens and of the world, the corps. Will be able to make introductions. Will be able to reach out and validate ideas with potential customers. So in your sector, you're looking for VCs that have a network that's relevant to you and to your customer. Reach out and talk to founders in the portfolio. They've been dealing with these venture capitalists. Are they adding value? Are they active? Do they participate? Talk to the venture capitalists. Dig. Do they have knowledge of your sector and your technology? Or is it just about placing money and moving on to the next? If you're bringing on a partner to add value, you want to understand that that partner, and specifically the partner that you will work with, has knowledge of your sector and your technology and where it fits into the big picture and how it can be disrupted. You want to understand that they have availability for you. You saw that J curve. As you go on later, there are more and more companies that are being managed by those venture capitalists. Their time windows are narrowing, but you want to be able to understand that you're going to get advice and effort from the venture capitalist partner that's making the deal with you, and ask the question and ask it in the references of other founders. Obviously, the first venture capital investment is not the last. It's a path, especially at your stage. So you want to understand that venture capitalist can follow on, make the next stage investment as you are growing the company, meeting milestones requiring more capital to go to the next stage, and that is there, and that venture capitalist has co-investors that fit the profile of what you would look for in a follow-on investment round. For example, a seed round, 2 million from a seed stage venture capitalist might lead to a $10 million Series A round that brings in a deep pocket co-investor that's able to do the Series A for 8 million, but can then do the Series B for 15 million to take you to the next stage. So at each stage, you have to be thinking of the next stage of investment. And you want to understand that the stage where you are, that this venture capitalist is in a position to help you do the next one. And integrity. You have to live with these people for years. Can be very painful if it's a relationship gone bad. So it's a relationship to be established with care and to be nurtured. And that works both from the venture capitalist side, my side, as well as the company side. So long-term, it's mutually beneficial. So it deserves work, and integrity is the base for all of it. I threw this in, I won't spend much time, but kind of state of the art now in stages of venture capital financing, with some ideas of what should be done at that stage and what should be accomplished at that stage and who would invest in that stage. But Pre-seed, seed, I expect that's where you are, all of you. Series A, Series B, Series C, these are companies that have reduced the technical risk and are now addressing the entering market and scaling into market. Mezzanine is kind of the last one before an exit to grow the company rapidly. And the exit is sale to another company, sale to a private equity, or public listing of the stock through one or other mechanisms. And when that happens, the founders and all of the VCs that were collected along the way all get to take a return on investment for the time and money that they put in. Whoops. This is sort of a picture of what's the venture capital industry in Canada look like from the low end of, from the origin there on the vertical is the focus by stage. So pre-seed, seed, early VC, and the growth stages. And the horizontal axis essentially what's the sector? As you can see, these funds are almost all specialized sector-wise and stage-wise. Funny, Innovacorp isn't there. I didn't find Innovacorp on this list. I see NBIF there. We've got Build is a Nova Scotia-based fund, Atlantic Canada-based fund that's right at that early venture stage. I'm sure you can recognize a bunch of these, but this is the landscape. US is, as usual, 10 times or more the number and the size, but similar concept. They're focused on stage and they're focused on sector. And they have different sizes, and the size of the bubble is kind of the size of the fund. And you can see that earlier funds are small. Some are even called micro VCs. I think in US, a micro VC is 100 million or less, which is, you know, fairly significant, but some of them are smaller. Sort of lays out, you know, you would start to dig into venture capitalists on their specifics based on knowledge of where, what stage, what industry they're investing in. And with that, I'll take any questions. Not sure what the time is.
So we're
I'm
at
not-
2 minutes after, so we've got about 25 minutes per question. Michael, that was awesome. Great insights and words of wisdom and advice for people kind of considering venture capital. So if anybody's got questions, you could put it in the chat, or you could raise your hand, and the raise hand is under reactions. But I've got a couple as we kind of start. What about VC specializing in oceans? So how much is it happening, or what's your insights on
There
that?
aren't any in Canada, unless you tell me different. There are no ocean funds in Canada, ocean focused. The first ones are being created internationally now. Part of that reason, like ocean tech, has been a very successful industry, but it hasn't been venture capital related. Pretty well everything in ocean tech to date has been spin-outs of research, spin-outs of corporations with a technology that has been validated, that is turned into a product and product service with a very tight focus, growing sales to $10 to $20 million over 5 to 10 years being acquired for 20 to $50 million in that period. So the ocean tech, and I would say, you take on venture capital, you give up the idea that I'm going to grow organically and sort and exit with a couple of $1 million in 5 years. You buy into the thesis that we're going to make this a massive company. We're going to grow it like crazy. We're going to dilute like, going to raise money and grow it. But the other opportunity is the classic ocean tech. I have a product or service. I sell it into market. I grow organically. I get bought. I never sell my shares to anybody. I keep them all. And that's what ocean tech has been. And we have a lot of good examples in Halifax, Newfoundland, ocean tech companies that have succeeded and founders that have exited. But it's a new day. Ocean is becoming the critical sustainability factor. It's not just defense and shipping. It's food. It's carbon. It's logistics of transport. So time is now for the first venture capital funds in oceans to start investing in the first early companies to be able to build that path. So pretty well all of the ocean in the world now, there aren't very many ocean tech VCs, are doing pre-seed, seed stage deals and creating the pipeline for future.
Maya, you had a question. Did you want to come off mute and ask it?
Yes, I have a question regarding how you determine valuations at Innovacorp. I understand you're focused on early stage, so I imagine it can be difficult to set valuations. And I'm curious as to what you look like, if you have some kind of scoring system, or how do you do that?
You know, we have templates and formulas of how to calculate current valuation based on future performance, but they don't really mean anything at this stage. So part of our thinking is this is how the industry is looking at this stage of company now, as far as valuation goes. And that's a moving target. And it's dependent on how attractive the company is to different investors. And some will have, like if you go to California, you'll get a high valuation for your first investment, and they'll put a lot of money. And if you do it in Nova Scotia, you'll get a lower valuation and they'll put less money. But there's less competition, more likelihood of raising funds in a situation, but like always keep open the opportunity to go talk to the US venture, because they will give you better valuations, more money, and probably more network too. But doesn't have to be first. We do very often now is we punt valuation down the road by first deals as convertibles, safe agreement for equity or convertible debenture, which define the investment as in a convertible, it's a loan that will convert on certain conditions. As a safe, it's not a loan, it's off the books, but it still will convert on certain conditions. Usually those conditions are that the company raises a priced round later. So a company at a pre-seed stage could raise 500 grand on safes that all say when, and they're all the same, that say when the company raises the seed round of at least $1 million, then everybody converts. At a valuation defined either as a percent discount of what it is worth when it raises that money, the seed round. So 20% is not unusual, 20% discount. or we'll convert at a cap, meaning we'll define maximum we consider your company worth at that conversion, and we'll convert at that price. So not unusual to have a $5 million cap on a 500 grand seed pre-seed safe round. Does that help?
Yes, thank you. That's that helps a lot.
So we'll go with Roy from Qualities, and then we'll go with Mark.
Thank you. Thank you so much, Shelley. Thank you so much, Michael, for the awesome presentation. So my question is, so I understand that so far, whatever the facts were stated, they are on a they've been stated on a historical basis. But how has COVID-19 factored into all of these? I mean, has the traditional focus changed? Have the industry priorities changed when it comes to venture capitals, or are they thinking anything new? Because we have seen a lot of interesting trends coming out of the COVID-19. Let's say housing, for instance. I mean, where in the towards the first the first half of the crisis, when a significant portion of the labor market lost their jobs. I mean, houses pricing were they were soaring on the other side. So do you see any such trends at all, or it's just something that's temporary and you expect things to go back totally in terms of venture capital?
Thanks for the question, Roy. It's like the more it changes, the more it stays the same. What venture capitalists are looking for is a massive customer pain and a willingness to adopt. So venture capitalists were very active in developing solutions for COVID because there was a significant pain in the market. Like, what are we going to do with this? It drove the valuations for some companies pretty well too, like Zoom. But it is a moving target. What was a customer pain gets solved. Like, nobody's going to invest in the next Facebook. Venture capitalists aren't going to do the next Facebook. But they're very likely going to be looking at what can we do in response to atmospheric rivers flooding our major cities. You know what I mean? A huge pain. What are we going to do about it? And they're always looking. I know mine was retrospective, but VCs are always looking forward. It's not, the solution is not there necessarily today. We're going to make it possible. The pain is there, but the solution's later. And that will continually change as, I guess, the world keeps changing. I expect carbon will be big. But the housing part, you have to consider, you have to step back and think, is it a venture capital play? Are the returns there? Can I invest in housing and get back my 10 times?
Right.
Yeah.
I just wanted to make a point. I didn't mean to, relate it to the venture capital thing. Sorry about that.
Yeah.
But thank you so much for the answer, Michael.
Perfect. Thanks for the question, Roy. Let's go to Mark, and then we'll go to Jason after.
Okay, thank you. Can you hear me? All right.
Yes.
Thank you so much, Michael. It's been very interesting. We are a seed stage company, and here's my question. It's more general, so I hope it's interesting to everybody here. We are an aircraft manufacturer. Our business fundamentals function no differently from other aircraft aircraft manufacturers. So VCs are very familiar with the model. What's different is there's been this huge disruption in aircraft, which is electric aircraft, right? We all have seen, or electric cars, right? The electric ecosystem. And this is what my question is in regards to. That disruption, which we had nothing to do with, basically allowed us to make a very light aircraft, less than 1,000 pounds, that can fly in weather just like a Hurricane Hunter does, which is a very large plane. And it all has to do with physics. So that's our invention. Up until now, because there wasn't this disruption in electric tech, that was impossible from a physical side. You couldn't get a weight to power ratio that made a light aircraft able to fly in that weather. So we're in this sort of green field. And when we approach VCs, there's a huge demand and the business model is sound. But we're in this area where if you have a need to fly in bad weather, there were no options except big plane or truck, right? So we're in this empty field. So although they recognize the business plan and they recognize the technology, our experience is they're not quite sure, not whether there's a demand for it, but like when you showed the circles of all the different industries, where this would fit. Is it a logistics thing? Is it a so that what I'm curious about, and this is where I'll stop, is when a VC gets something like this, where they're experts at the business fundamentals, they can look at the team, they can do all of that, but there's not a lot of historical data. How do they treat that? Do they do this? Do they truly make a guess, or do they bring in experts, or do they just go on the business fundamentals, or how do they treat it, technology that couldn't exist 10 years ago, not because we're geniuses, but because the tech just didn't exist back then?
How many have you talked to?
Well, I've talked to many VCs in my career, and we've talked to probably 8 or 10 seriously, and they're all extremely interested, and they go through all the business fundamentals as any VC would, but then they don't have a lot of comparison data, right, for this. So we can do sales first, and then they can base it on our sales. That's one way for us to proceed, which is not a problem. But they seem to be behaving differently from when I've dealt with VCs in the past, where we've had companies that fit into one of those circles, for example, you showed again in the beginning of your presentation. We don't fit. In fact, you didn't even have like aerospace in there, right?
No, but, and again, that's old stuff. And aerospace was essentially not a venture capital play.
Exactly.
Aerospace was NASA, right? Or Boeing, or.
Correct.
Yes. But aerospace is a venture capital play now. All the satellites going up, all of the information, the data, all of that. Decarbonizing aviation is a big one. It's a long way out. I don't know if yours is a solution to decarbonizing aviation. Sounds like it. If that's the play, maybe you're not talking to the right investors yet, because there's a clear VC thesis to develop those solutions.
Sure. I mean, it mainly falls into what you just said. And again, thank you for taking my sort of long question. But what you just said is the issue, that 20 years ago, there was no such thing as VC investment in aircraft manufacturer, because that didn't make any business sense, right? And now it does. And so that's what we've run into, is not in industry issues in terms of whether we're saving carbon or whether, the business is sound. The question is, okay, now we all suddenly have the potential for this type of growth in a market that historically didn't exhibit this. And that's where the both the interest but also the hesitation has been. So thank you. I'll stop there, but thank you for taking the question.
Sure.
Thanks.
My
Jason,
suggestion is talk
go
to
ahead.
more venture capitalists.
Jason, you had a question.
Yeah, hi everyone, and thanks, Michael, for the presentation. Michael, I'm curious, like you talked a lot about, like, in the ocean tech industry, a lot of it's been organic growth. Now it's kind of moving into the VC area. Like, how do you, like, are there average numbers yet about an ocean tech company and how much they're valued at a seed round, and approximately how much they raise? So this is essentially not yet Series A, but they have some validation, like they have a safe or convertible loan note, some government funding. I'm just wondering, like, do you have any ballpark numbers on valuations and how much companies are raising at the seed level in Ocean Tech?
I don't really. I know that the CDL Ocean Stream has been doing some deals, or CDL Atlantic with ocean companies. They're raising money, companies like Ocean Robotics, and there are others that are raising money at seed stage to grow the business. But I'm not sure how much or what those valuations are. I doubt that the ones that are raising money are much different in amount. And amount is totally dependent on how much you need and you use the proceeds, of course. Amount and valuation, I doubt they're much different than other high-tech sectors. Like the companies that align with a venture capital thesis should be able to attract the same kind of investment and valuation as other tech. Not always the case, particularly for IT, but I think part of the issue with Ocean Tech is no one's had exits really. So it's kind of hard to trace that path. But if we can assume that you can make the case that the customers will be there, the pain is there, then you should be able to build a story that accesses the same type of valuations as a device company and Internet of Things, for example.
And so what would some of those averages be, like in the other sectors then of a seed company?
Well, seed like a seed would be like 2 million to 10 million. I've seen both. Under 2 million starts to be small, but you could talk about 1 million. But a seed round of $2 million for 24 months operations to deliver those key milestones of, product market fit,
Yeah,
patent protection.
and that's how much
and
it's being
evaluation,
raised. Yeah.
You never really want to give more than 30% of your company on any stage raise. So, calculate it.
Yeah, that's
Keep
very
it under
helpful.
30% dilution. And how much money do you need? Less that you need to meet those key milestones, better off you are.
Yeah, okay, perfect. That's very helpful. Thank you.
Sure.
We've got less than 10 minutes. Other questions?
I can jump in with a question. When calculating pain and market size, should I count the number of customers present today, or is it okay to predict how many customers I think I will have in the future? And if so, how many years forward should I be predicting?
So, I don't know. I would look at it as, I wouldn't assume there are going to be more customers in that segment than there are now. I would assume that you'd have the same number of customers, but like they have a pain that's increasing. And that the pain may increase. Like if taxes on carbon, for example, go up, that increases pain, or if regulations change that force certain things. Or if like what used to be an affordable feedstock is now gone and like it has to be replaced with something new and innovative. I could see the pain increasing. So I would build it that way. Like I could like the forward-looking piece is really about how many customers can you acquire. and what does your margin look like as you grow? But I think I'll come back to one of the problems we see often with startups is they see anybody who could buy their product as the customer, and they may be from half a dozen different segments, industries, but hey, they could all use it. So I'm going to try and sell to all of them. Like that's, for us, that's a walk away. The whole thing becomes, you have a solution for a well-defined customer that you can justify as being big enough through to take business and grow a company. I read recently, like, a startup is not a business. A business has to think about, okay, how can I acquire new customers in different segments just to grow their business? But they're an existing business that's looking to grow. A startup has to be, who is my landing spot? Where is my first customer? Be very careful how to pick them. You can always pivot, but be very careful. And then focus totally on delivering to that customer and making the case that that customer segment is big.
Thanks, Michael.
But Michael, just a quick one. What if you were quite successful and you see some network effects across various customer segments? Would that be a time to engage in a broader swath?
I guess it's about, as a startup, you're validating stages of progress and value increment. So if your value increment is based on revenue and different customers, like it generally is for a SaaS company, then I guess that could be useful. But generally, my experience is getting network effect from multiple segments for a startup is a distraction that can be really difficult, cause problems. So it's almost like the customer will still be there, that other customer. So, maybe it's two to try and hedge your bets, but again, there's always exceptions, but for me, the rule would be decide who your customer is up front, that customer group as sort of one profile, and do everything to acquire it.
So Michael, kind of is dealing with the venture capital like Dragon's Den? So kind of like, what's kind of the engagement? What should people expect? And how soon do people talk to VCs?
So you're going to get more of this on your investment readiness path, I think.
Okay.
Jennifer, I know John, my partner's coming in with what's a term sheet, and like that's where it really hits the wall, where you have to talk to them and what do they really want, and like, do they really mean that? But I would say it's never too early for a first chat, but be sure that you've got very clear in your mind before you approach, what is my 30-second pitch that defines my value? And value to the customer, right? Like, we've got a solution that is addressing this $10 billion problem, and we believe we can do it this and that. And we need this much money. We're going to be looking for this much money to get to that stage. I've also understood that in most cases, the best way to approach a venture capitalist is to be introduced. That they get all kinds of emails and they just trash them. I don't generally do that. I have done it, but that the best way to get introduced to a venture capitalist is by a venture capitalist or an accelerator or a mentor or a partner. And then that starts that discussion. But again, think of it as the stages. You're going to approach a venture capitalist based on the stage and what you expect to achieve in 24 months with the money you're going to raise from them. So think about, what's that 24 months look like? What are the milestones I need? How much money do I need? And before you go, approaching them. And I think, yeah, Jennifer's got a schedule for you to start working that out. I think my colleague Ben is going to give you the pitch deck, which essentially sums up what you need to kind of pull together as information in your mind before you approach.
Perfect.
I know some of you have raised money already. You can you can no or yes, depending on your thought.
I know we're down to the last minute. I know there was a question about data rooms, but I think we'll cover that in the next workshop. So we'll save that after. Michael, thank you so much.
My pleasure.
Very informative. I'm sure people have learned lots. So thank you so much for doing this. And I'm going to pass the last word over to Jennifer on the reminder of the next workshop.
Sure thing. Yeah, I'd like to say just thank you again to Michael. Thanks to everyone for attending. So again, this is the first session of our 4-part investment readiness series. The following 3 sessions will dive deeper into developing your funding path, perfecting your pitch, and like Michael said, closing the deal. If you have not RSVP'd already and would like to attend, please send me an email. And if you have already RSVP'd, we look forward to seeing you next week. Thanks, everyone.
Good luck to
Thanks.
everyone.
Thank you.